Hello everyone, this is Tom Fox. I'd like to welcome you to episode 6 of Across the Board. Across the Board is a podcast on boards of directors and corporate governance. We take a look at issues relating to the board of directors and those who report to the board of directors. In this episode, I visit with Rakhi Kumar. Rakhi is the managing director, ESG investing and asset stewardship at State Street Global Advisors. We visit about a recent white paper released by SSGA entitled Perspectives on Effective Climate Change Disclosures. We take a look at issues related to how climate change impacts businesses from the board of directors' perspectives, what the board should request in terms of oversight to prepare for disruption due to climate change and climate impact, and finally, the business opportunities for companies which engage in strategic risk management around climate change. Rakhi has a great line, which is that assets should not and cannot be stranded. And if you don't take a look at this from the board perspective, you may find that your assets are stranded going forward. Across the Board is a part of the Compliance Podcast Network. Hello, everyone. This is Tom Fox. I'm the Compliance Evangelist, back with you for another episode of Across the Board, the podcast where we take a dive into various issues relating to boards of directors, risk management, and the strategic use of risk going forward. We take a look at it from the board's perspective, we take a look at it from the investor perspective, and we take a look at it from those who report to the board. Today, you are in for a real treat because I have back with me Rakhi Kumar. She is the Managing Director, Head of ESG Investing and Asset Stewardship at State Street Global Advisors. They have recently released a report entitled SSGA's Perspectives on Effective Climate Change Disclosure. As most listeners know, I'm from Houston, so I've been thinking about the climate quite a bit over the last couple of weeks. But this report is really much broader than weather, and certainly hurricanes and even weather. And Rakhi was able to take some time to visit with me on this because I think it provides an important set of issues for the board, for investors, and for those who reports to the board. So, Rakhi, with that somewhat long-winded introduction, welcome and thank you for coming back on the podcast.
Thank you so much, Tom, for having me.
So could we start out by asking what was the purpose and methodology of this report, and why did you guys want to put it out to the investing public?
Yeah. So for us, as an investor, we see climate as a risk to our portfolio, climate change related risks as a risk to our portfolio. And what we have done here is we're trying to give companies insights into what information we find helpful in their climate disclosure to give us the comfort that the board is taking notice and paying attention to these long-term risks, as well as the company is taking a robust process to incorporate and mitigate these risks, as well as seek opportunities to position the company for long-term.
So I really appreciate that very holistic not review, but holistic approach, because you're not simply talking about detecting or preventing. You're actually talking about using it in your strategic risk analysis going forward for business opportunities. So I was wondering if you might be able to go into the 4 areas where SSG feels that a board can better position climate change risk for its organization.
Yeah. So one of the things that we want to do is we want to clarify that our job is not to micromanage companies. Our job as a shareholder is to elect the best board we can and give the board the leeway to provide the oversight required to manage, mitigate risk, help set strategy, and oversee management. And so what we're trying to do is identify 4 areas which give us insights into, one, is the board involved? 2, are they undertaking planned activities and robust activities to evaluate climate risk to their portfolio, to the company? And the third part is, are they incorporating the impacts of climate change into long-term strategy? So we are focusing on the areas we've called out are governance and board oversight of climate. How is the board providing the oversight? How are they establishing and disclosing the long-term GHG goals, the greenhouse gas emission or goals? How are they disclosing the information on carbon price assumptions? What are their average and range of carbon price assumptions? And finally, how are the impacts of the scenario planning exercise really being incorporated into long-term capital allocation decisions?
So, Rakhi, I was wondering if we might be able to unpack each one of those. And first of all, I appreciate certainly your thoughts on the role of the board as oversight. It's not to micromanage or really even manage, but it's there to provide that oversight. And really, how can the board do that from the governance and oversight of climate risk perspective that you detailed in your report?
Yeah. So just as background, before we get into the unpacking of each of these items, I wanted to tell you the methodology we undertook to get to these, to identify these four areas. What we did as a global investor, we invested in many oil, not only oil and gas, but all companies, over 10,000 companies globally. And what we did is we focused on what we call the high impact sectors, which are oil and gas, utilities, and mining sectors, which really the time horizon for making capital allocation decisions are so long that you can leave, the assets can be stranded if they're not, the decisions are not made with information in mind that will be impacting what tomorrow looks like. And so what we did is we looked at 50 companies in these three sectors, global holdings, and broke their reporting into, we looked at the climate reporting and divided them into two groups. The ones where we thought the climate reporting was useful, and a group which we thought it was not useful. And then we took the reports that we found useful to say, why did we find these useful? What's common about these reports, which we can extract to say, this is not company specific, but it's really information as an investor I get comfort around. And that's how we identified the four areas. So with that, let's go into each of the items. Governance of board and oversight. You'd be surprised at how many companies do not tell you, in these sectors, tell you how the board oversees sustainability-related risks, so environmental and social risks, right? The companies, there's some companies, a lot of European companies, and to be fair, even in the U.S., you have some of the leading oil and gas providers, etc. They have sustainability committees that are focused. Their job is to oversee this risk. Then in some companies, even in the oil and gas sector, they will not just address how, they don't have it in even the charters or any such thing. But the insight that an investor gets is, okay, who is really responsible and what is it being looked at in a structured manner by the board if it's an important risk. The second item is establishing and disclosing long-term GHG goals. This is an area where we got a lot of pushback in our engagement with companies, especially U.S. companies. They often will tell us that, look, we don't want to. We'll give you disclosure on actual emissions from our operations on an annual basis. But we really don't want to set goals, because if we set goals, they can limit our ability to make investment decisions. Or for example, you get a good M&A opportunity, and that year, if I buy an oil field which may be, brown, then I have busted my GHG goal that I set. And the answer as an investor is simple, right? It's okay. Goals are long-term directions that you set. But if there's a reason for not meeting a goal, it's okay to explain it. And we as investors should be open to that. And companies do it all the time when they'll give you non-GAAP reporting, or for, say this is a one-time write-off, so don't consider this in your long-term views, etc. The second aspect of it's important to look at the goal is because when you understand the overall your cost of actually buying that brown oil field, how much money you're going to have to put in to make it green to get it to your standards. And you may be overpaying for that asset. And so these are some of the reasons we think actually setting long-term GHG goals, and we don't mean 1-2 years, we mean 5 years, 10 years. The other bit about setting goals is that any report, any scenario planning that you do requires assumptions. So when you put in a number, we want you to give some thought to what number you're going to put in as to what your emissions are going to be. And that means it requires you to do some rigor and robustness. It helps build in that robustness in the process. The third point we've
Rakhi,
asked
before you get to that third point, can I follow up on that? Because I found it really fascinating for a couple of reasons. And let me see if I got this right. Because it sounded like to me what you were talking about was two things. One was really just a standard business process analysis that a company would go through on any investment. But here you're asking them to consider climate as part of that, and within that, in an overall risk risk management process where you look at the risk, you evaluate that risk, you see what that risk might cost you to remediate, and then make a financial determination, is that risk worthwhile? Did I understand that right? In point two, on establishing and disclosing goals is really just part of to facilitate your business process?
Absolutely, because what you're really trying to do is to incorporate the biggest challenge companies have is quantifying the impacts of sustainability, or how do you put a dollar value? We're used to focusing only on issues that have very significant dollar values attached. And in the current system that we are in, we do not know how to price, right, your impacts or risks appropriately. And so I think that's the challenge. And you need to then look at various kinds of scenarios and plan for scenarios. But then that's the carbon price which I was talking about. But a robust process will have to say, okay, I need to understand the impact, and this impact may be through a quota I may have, like which on my GHG emissions, because I have regulation, or I have a world tomorrow which will be expecting me to control my regulations or my emissions, etc. Does that make sense?
It makes a lot of sense, and I guess what I'm hearing is you're obviously speaking from the investor perspective, but as a board, I would want to see that sort of rigor in a business process for any significant investment or any significant asset that my company would have, because it's the process to me that's important, the rigor in the process, really not even as much as the final answer you come out with, but if your process is rigorous and there's transparency, I would find much more comfort in that.
Exactly. And that's the beauty of the 4 items that we have identified. It really is meant to, none of us are climate experts, right? And I cannot tell you if your carbon price at 7 is right or should it be 14. That's not up to me. That's up to your expert who you've hired, whose responsibility it is. But I can certainly say you're using 7, but somewhere in Europe, somebody's using 14 with the same kind of footprint that you have, or the same kind of ownership or split of oil and of kind of reserves that we have. So why are we using 7? Right? And so it's only giving us the information to question and dig deeper without having to become experts. Now, as you said, the idea is not to have the right answer. The idea is just to test robustness.
So you started to touch on carbon price assumptions. Obviously, in Houston, when we're up and running, that's a very big issue. So why don't you take us into that issue?
Right. So carbon price, again, is a very sensitive issue with a lot of companies. It's considered very, we've often been told that it is a price that will give away a lot of competitive information, which is why we've stayed away from the exact price, but we just talked about an average carbon price, which I think is okay. And then we've talked about both an average price as well as a range of price that you're using, because your carbon price will differ based on your geographic ownership or where you are located and your oil fields are, etc. So I think that's but the carbon price is an important mechanism. It's pricing. It allows you to price, right, the risk into that model that we've talked about.
Right.
And so So that's why it's important. And, one of the questions I ask is, okay, if companies here in the US or in Japan, for example, or some other places say that we can't disclose carbon price because it's competitive. So I said, okay, then how do you use the information provided by your competitor, by your peers in Europe to gain a competitive advantage over them, right? If that And I haven't still gotten a response that is robust or compelling, let's just say, as to, look, this tells me XYZ about their strategy.
Okay.
And then the fourth issue is really about discussing the impacts of scenario planning on long-term capital allocation decisions. I would say most companies do not provide any disclosure on this. I think we've called out Statoil's reporting as this gold standard as of now with regards to scenario planning. And for example, and we don't want details like what Statoil has done, for example, is it says that it'll allocate 15 to 20% of its capital expenditure by 2030 to new energy solutions in response to the results of the scenario tests that it carried out. And to us, again, I don't really care if it's a 10%, 5%, 20%. I think what it tells me as an investor is that the board has understood what they're trying to do and then incorporated, that's the biggest thing, incorporated the outcomes of this test into its long-term planning. And then the conversations I will have with the board members will be more around, so you said you've had no impact and it's not impacted your capital allocation at all. And it just allows you to have a conversation to get to understand what are the considerations what issues did the board consider to come to that conclusion.
Well, Rakhi, it seems to me you've really laid out the process for risk management, and the risk management process is what I really advocate that boards consider, whatever the specific issue here is. And then you've ended with some things that I think really crystallize why it's so important. Number one, it demonstrates scenario planning exercise is conducted as a strategic review and not an isolated exercise. And in my visits with you for a couple of podcasts, you've really emphasized that the strategic review, or what I would call the risk management process, and the process nature of what you're asking these companies to do. But from the board perspective, that is something that I would absolutely demand of my senior management is, what is your process? And it's not an isolated exercise. Do you find that to be accurate as well?
Yes, and I would wholeheartedly say that we don't have the answers to all the issues. All we have is our ability to provide insights into what we find useful. And again, it's not the answer; it's the process that is most important. And people make mistakes. There's good faith errors. There's but shame on us if we do not even see the risks that are right in front of us. So I think the idea is that you may miss it, you may plan incorrectly, you may make the outcome may be wrong, but at least you've given some thought. And I have a lot of confidence on with regards to the quality of directors we have on boards to say that most of them do the right thing and they all want to do the right thing. So that's how what we're hoping that this paper helps them as much as it does the other investors in understanding what we expect.
And I guess the other thing that really has intrigued me about not only this paper, but your discussion is something that I see when there is a risk, there's also a business opportunity if that risk is properly addressed, monitored, and managed going forward. Do you or the State Street also see a business opportunity for companies which engage in strategic risk management around climate change?
Absolutely. I mean, for us, opportunity is the other side of the coin when it comes to risk, right? You're going to see a risk, and at the same time, you can also see an opportunity. And what do I mean by that? I can give you a few examples, right?
That would be great.
We've and sticking to climate, there was a real estate company that we were engaging with, which talked about building along a shoreline. But before they actually draw up their plans, they actually incorporate 100 years worth of climate change patterns to build on a shoreline so that they can then make sure that the building is protected despite being offering the, ability to have great views, etc. But that helps the insurance cost. And it just makes sense. So I think that's an example that we can talk about. Another issue is, we were talking to a company that has gas turbines. It has a monopoly, or it's a large provider of gas turbines. And they said that, what's happening is that wind turbines are becoming, the growth in wind turbines is far more than gas turbines right now. So, we better pivot very quickly. And otherwise, we're losing opportunity because we may be the kings of a dying business, but we don't have a foothold. We don't have a foothold in the growth business. So those are examples where you really need to focus on these risks and then question yourself on whether your capital allocation is appropriate to exploit opportunities.
I really like that last point you raised, because I try to communicate that if you have a robust process, even though you might think it actually takes time, money, and effort, it actually makes you more nimble because you can make these responses. You can see these market trends, and then you're able to respond more quickly before your competitors do because you have more information on which to base your decision, even if that's a capital allocation decision literally years down the road. So I really think the process you've laid out actually makes corporations much more nimble in their ability to respond.
Yeah, I would agree, and yeah, good. You make a very good point there. Yeah.
So unfortunately, Rakhi, we are near the end of our time, but as always, it's been a fascinating podcast. Hopefully, I can link to this white paper so that both boards, investors, and corporations will be able to take advantage of some of the best practices that State Street Global Advisors has been able to identify, and hopefully then use this information both specifically around climate change, but also around their process for risk management. So as always, thank you very much. I've been speaking with Rakhi Kumar. She is the Managing Director, Head of ESG Investing and Asset Stewardship at State Street Global. Rakhi, thank you, and I look forward to continuing the conversation.
Thank you so much, Tom. Bye-bye.
This is Tom Fox again. I'd like to thank you for listening to this episode of Across the Board. If you have listened to this podcast on iTunes, I would appreciate it if you would rate our podcast, as it would help in our rankings and also help get the word out about the newest podcast relating to boards of directors, corporate governance, and their roles going forward in risk management. Also, if you have any questions, please feel free to contact me at tfox@tfoxlaw.com. I hope you enjoyed this episode, and I hope that you will join us again for another episode next week of Across the Board. Across the Board is a part of the Compliance Podcast Network.